Talk about adding fuel to a fire as you're walking out the door on a Friday. I mean, just wild. And the impact it's going to have on the market this week is going to be crazy, and we're already seeing it here on Monday morning. The other thing we're going to talk about really quick, we're going to talk about this is a light data week, but don't be fooled. And then lastly, I want to talk about how can we generate some urgency in today's marketplace. My name is Kevin Weedmark, aka the Mortgage Mouth. Thank you so much for tuning in. This is the week ahead, brought to you every Monday, so we can all be kind of in step on what we anticipate could be a market mover for the week and what we should look out for, and more importantly, what we could potentially be telling our clients to look out for. So let's address the big news. On Friday, 10 minutes before the close of the bell, Moody's comes out and downgrades the U.S. credit rating. Now, mind you, they're the last to do it, and it's very familiar to what they did in 2011 as well, as we were coming out of that entire recession, market crash, whatever you want to call it. Very similar to what they did back then. But in this current environment where you're dealing with tariffs and you're dealing with a federal deficit of $36 trillion, this has an immediate impact. And what we're seeing this morning already is we're seeing a huge sell-off in treasuries. We have, I want to say the 10-year is up over 0.12 at the present moment. So it's going to put a lot of pressure on interest rates. And unfortunately, there's not much we can do about it. There's no immediate reaction, I think, that can quell it, because it has investors fearful of, okay, we do have a downgrade. Is U.S. debt going to be as appealing as it was? I think it is. I don't think that's going to change the trajectory for any investors on a global scale. However, what it could do is it could change the cost of that debt, meaning that it could put inflationary pressures on the U.S. on an overall scale as they have to pay more to borrow money. So a creditor like China, hey, we want you to come by, we need you to borrow some money. It's going to cost us on an overall scale. They're going to say, well, your credit rating's not as good. It's not a AAA, so we're going to need some more funds. So this is not good news as we're moving into a week where I perceived on Friday, because I didn't even realize the data came out, that we were going to have a light data week. It was going to allow investors an opportunity to digest all the information that they had heard, lower inflation, blah, 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 and we would see rates ticking down. It's the exact opposite. Once again, it's the volatility in the marketplace, and it can happen like that. All right, what else do we have this week? Now that we touched that, I think that's going to play out, and I'm going to touch on how I think one thing that I believe this week could change it. Speed dial. Make sure that you have your mortgage professional always on speed dial. Should you not have one, would love an opportunity to talk to you. Once again, this is just for informational purposes, this whole channel. If you need specific information, more than happy to dive in and talk to you about your situation specifically. But this week, I would expect volatility. I thought that before the whole Moody's thing, just given that we're going to have investors really digesting, moving back and forth, could get some tariff news. I would really have your mortgage professional, especially if you need to lock this week, on speed dial. The big data points of this week is going to be initial jobless claims. Jobs is always going to be one of those. So every week that goes without saying. But the two things we have is we have manufacturing PMI and services PMI. And frankly, I hope that both come in lower than forecast. Although I would not be surprised, and I do not think manufacturing will. It's a huge push by the Trump administration trying to bring back all this manufacturing back into the United States. So I think that number is going to be above forecast, if not at forecast. And what that is, and PMI is Purchasing Managers Index. So what they do is they go out and they survey about 400 purchasing managers. So they get a beat on the streets. right? Traders love this data because it kind of gives them a look under the hood before all the data points actually hit. So you have the manufacturing side and then you have the servicing side. The servicing side, we want to come in under forecast because we want to keep reassuring traders that inflation is at bay. If you see a huge spike in that, it's going to mean that the pricing in the long term could be going up for just general consumers, and that would be a really bad thing for the bond market. Another thing to just add. The one thing that I'm hoping that we hear is we have several Fed members speaking this week. I hope with the news of Moody's and the downgrade that they come out and change their vernacular to help ease the markets, to put the market at ease, to help people understand it's not really that big of a deal. We're going to be fine. It's a little hurdle that we have to get over. So I would not worry about it. And maybe, just maybe, they say this may have to accelerate them decreasing the Fed funds rate, right? So now this is starting to come in full picture where you've had the Trump administration pressuring the Federal Reserve Bank saying, downgrade these. There's no reason for this debt to be up, right? There's no reason for us to have these high Fed funds rates. Decrease them. Maybe that adds some pressure in order to do that so that it would bring down the cost of money of what the government is paying back. Because these tariffs, let's be honest, they've helped in reducing the overall, in paying down some of the federal deficit. The problem is all the past spending expenditures are just not in check. They're just running on check once again. So until Congress gets their ass in gear and actually passes something to start reeling in this so we can start bringing down the federal deficit, this is why we're sitting at this problem. And then the last thing is, once again, I'm always trying to bring what could be something that could be beneficial to all of us and our clients. And how do we create urgency in a marketplace right now where it doesn't seem like there is a lot, right? We have the news of tariffs. We know that interest rates are high. We know that we know all the home sales data. We're going to get more this week. It's just not painting a great picture. So what are things that we can do to kind of help move and help our clients move that needle along? Because again, if they're in the market to move and they want to move, they have the need to move, it's the right time. So we need to help them. Number one is, I thought, create time-sensitive value. You're not looking to pressure them, but time-sensitive in the fact that, hey, the home builder's only offering this buy-down rate to the end of the month. The seller, I talked to them, they'd be willing to do a buy-down, but they're gonna need to see an offer within the next week. Things like that to create a time-sensitive, to get them thinking that, okay, we only have this short window to make decisions. You're trying to help them make decisions in smaller blocks. Number two, show the cost of waiting. I love this one. I think it's great. If you're showing them, hey, at today, 7%, you buy a house and your loan amount is $500,000, well, you may be looking at a year from now when you're trying to predict the market and lower interest rates of 6%. Well, the price of that house could be $550,000. What's the difference in that payment? What is the true cost of waiting? More than happy to help you with that. More than happy to paint that picture of what those numbers mean to help you guide your clients in that and have future discussions. And then the biggest one I think that we all can do is position yourself as the inside expert. What you want to do is, hey, you just saw a price drop in a neighborhood they were looking at. You thought you saw a great home. You have private listings that you know about that you would love to take them and show them. You want to show them that you are on the inside. You're the expert. You're the one with the inside beat that's going to give them that added edge to make that decision now, because you know exactly what's going on in the marketplace. You have a great pulse of the marketplace, and you're bringing them opportunities that they would not see in working with somebody else. All right, y'all. Look, I was hoping I was coming to you with better news. This Moody things is really causing interest rates to spike on Monday. Again, I would not get crazy. I would not panic. I would ride out these peaks. I think it's going to be temporary. I think it may be setting a new, what do I want to call it? A new spread for the 10-year Treasury. I'm really hoping that the Fed members coming out this week and speaking will ease a lot of the perceived tension and perceived negativity this is putting in the marketplace. I'm hoping that they can ease that with a lot of their vernacular this week. Given it's a non-data week, I think that's got great potential. So let's keep our eye on that. You need anything, you need a pre-approval, you need some marketing material, you want to sit down and just talk shop, because I got some great ideas and how I can help you move homes and get more active in the marketplace, I would love an opportunity to do that. I hope you all have a great week. Happy selling out there, and I will talk to you every day later today with the Daily Dose. So make sure you tune into that YouTube channel, just giving you a very quick 2 minutes of what happened and how it affected rates for the day. I'll talk to you soon.